A lot of these programs are programs that you would offer clients once they're already in the home, but I'm going to talk about programs that you can actually do while you're there buying a house that will be helpful for you guys trying to sell somebody a property by helping them see what could be the outcome or the future of adding an ADU to the property after they close escrow. So let's go ahead and start there. So the first loan is the 203K. So if you guys have heard of 203Ks, usually everybody always talks about the renovation piece for it, right? If the house needs work, oh, the only way we're going to be able to close, other than having the repairs done before close of escrow, is doing a 203K loan. But you can actually use a 203K loan to do an ADU as well. But it has to be attached to the house. So you can do a garage conversion ADU. You can do an addition to the house, but it has to be attached to the property. So for example, if you want to do a mini ADU right onto the property, right onto the house, 203K FHA will allow you to do that. Along with, again, being able to renovate the entire home at the same time. So when you're out selling the property, somebody tells you, well, I only want to buy a house that has already a permitted ADU. You can't find one in the price range that they're looking or qualified. This is a good thing to share with them and say, hey, look, maybe you're looking at this the wrong way. Why don't you look into doing financing for it so that you can do the ADU after you close, but build it in on one loan? Because you're able to finance not only the property you're buying, but you can finance the ADU project right onto the financing as well. And the beauty of this is that it uses the future value of what that ADU is going to add to the property. So sometimes people say, well, how are you going to be able to do that if the house is only worth this much? How are we going to be able to finance 100% or 96.5%? Well, because the appraiser is going to be able to use the future value of that ADU onto the appraised value of the property. And so we don't technically use the purchase price, we use the overall project as a value. This is also really good when you have a property already that you own, right? Because you can do this as a refinance. So 203K, you can do a refinance where, again, sometimes people tell me, well, I don't have enough equity to do a cash out, which I'll talk about that. I don't have enough equity to pull enough money for an ADU, and I'll tell people a lot of times, well, you don't, because they cap you at 80% loan to value for a normal cash out. Well, in this case, they'll let you do a refinance and go all the way up to, again, 96.5% value of the house, of the future value adding the ADU, so that you can finance that ADU onto your house even if you don't have enough equity when you already own the home. So you can do it as a refi, you can do it as a purchase. But this program, again, only allows you to do it as attached to the property. So any questions on this one so far? So the next one is the Fannie Mae version, which is a conventional version of that 203K, which is called Homestyle. So Homestyle works pretty much exactly the same as the 203K, except that this one does let you do a detached. So you can do a detached ADU with this one. This one I would recommend for somebody that has really good credit scores, good income, because you have to follow Fannie Mae guidelines, so the debt to income has to be under 45 for the most part. You can go up to 95% loan to value, which means that, again, you use future value of what that addition is going to add to the project. This one you can actually do pools, like swimming pools. You can do, again, detached units, garage conversions. Pretty much the same thing you can do with the 203K, except that you can add a detached unit and a swimming pool to this, that the other one you can't. Same thing, they're going to ask for a consultant, because everything's going to be considered, when you do an ADU, structural, so you're going to have a consultant attached. Even though it's not an FHA loan, they will require a HUD consultant as well. This program, the difference between the FHA and this one too is that you can use it as a second home, investment property as well. So it doesn't have to be you buying it as a primary. I use this program for somebody that bought a cabin out north somewhere, and they use this program to do the renovations and all kinds of stuff, and it was for a second home, so they can do that. This, and same thing, you need a licensed contractor. Pretty much mirrors the same guidelines for the contractor as the FHA version of it. What's the credit? So they say it's 620, but for DU to approve, I'll be honest with you guys, like, I don't get in a DU approved for anybody less than like a 680, and it's just just the way it works. And plus, with this type of program, if your credit's below 680, the rates are going to be ridiculous, or you're paying a bunch of points to get within the budget for the DU to be able to get approved. So I think this is the program you use when you have really good credit, because otherwise you're going to be priced out, and people are going to look at it and be like, oh crap, that's a lot of money for the interest rate or whatever the case may be. So it's crazy.
What's the minimum down payment?
So that other one is 3.5%, just like FHA. This one is going to be, you can do 3% down as a first-time buyer, but you're already existing buyer as a primary residence is 5%. Just like basically mirrors the guidelines for conventional. Investment 20%, second home 10%.
Yeah. 20%.
For investment, yeah. So the next one is the home equity line of credit. So this is probably the least invasive of them all, especially now with the home equity lines of credit that exist right now. So with our banks that we use, they have AI involved in all this for the most part that makes things a lot easier for everybody when it comes to applying. We submit the application. We just got to be careful about being realistic of income and all that good stuff, because once it gets approved within like 5 minutes, then the client's going to have to hook up or link their bank account, the primary account, and it literally counts and looks at the deposits and matches up what we said on the application. If it matches the income, then that's all the income that they need, and they'll approve it, no appraisal, and within 5 days they can already sign docs and get their funds 3 days after that. So within a week or so, you have money's already deposited in your account with these equity lines of credit. So those are the ones that have the easiest process, but those are the ones that also have the most rigorous, like the requirements are tough, because you have to have really good credit score, a lot of equity, and your income has to be something that gets deposited, usually payroll. People that are W-2 employees are the easiest ones where they can look at their deposits. If you're self-employed, a lot of times they're going to red flag that and say, well, I don't know what deposits are yours and what are not your income, so now we're going to ask for your tax returns. So, but if you're a W-2 employee, these things are very streamlined, make things a lot easier. But if you require more of the manual type of home equity lines of credit, then we can do the manual full doc loans like everybody is used to. Bring your base stubs, bank statements, and all that good stuff. So the difference is too, on the automated HELOCs, we don't decide on the loan to value, max loan amount, the system does. So it literally spits out what you qualify for based on what the algorithms they use. And on the manual versions, we can go up to 89.99% loan to value. So for example, if you only owe 100 grand on your first mortgage, your house is worth $1 million, we can go up to a $750,000 line of credit, up to 89.99 loan to value overall of your property on the manual side, which means that it is going to be full doc and appraisal and all that good stuff. If you want to take a chance and you feel that you're confident you have good credit, income solid, a lot of equity where you don't really need an exact amount, but you just want a minimum amount, there's that 5-day HELOC that's super awesome to do, and things get happening pretty quickly. So this again is for people that already own a home. So, but okay, so that's the cash out refi. So this is for somebody that says, I only want one loan, I don't want to do a HELOC, or the rate on their first loan was high enough where we do a blended scenario and we say, you know what, it makes more sense just to do a cash out, do one loan, and then just do a 30-year fix and just set it and forget it. Take the money out before you start the project, but get enough money where you're not going to run out of funds, and then that way you don't have to have 2 loans and go that route. So this one, depending on the loan to value, you may or may not need an appraisal, but it is going to be a full doc loan that you're dealing with on the cash out. So I would only recommend this for people that have a pretty high interest rate already on their first, have a lot of equity, maybe never refinance, when the rates were at the lowest, or maybe got their house and then refinance a few times and then they have a higher rate. then it makes sense to do this, to do a cash out refinance. And this is, again, monies that you take out, and then you don't have to worry about a licensed contractor because you have the cash on hand and you can do whatever you want with it. And the bank wouldn't technically ask you for anything, because if you put a purpose, we can just put home improvements, and they don't really ask for proof of what improvements you're doing. That's just what they put as an excuse for you to take the money out. And yep, so any questions on this one? Because this one's pretty easy,